Today, NIFTY gave both a perfect shot and a perfect trap, and the only way to understand this day is not price but value. Welcome back to Mind Monastery. Today's session is extremely important because it was not a trend day, it was not a random day even. It was a multi-phase auction with failure and value disagreement. So let's first understand the importance of POC migration before breaking down today's market move, because this is going to be interesting and very important for you. This candlestick chart displays a standard technical setup. Watch the price break cleanly below this horizontal support line. It appears to be a definitive move right up until it snaps back in a violent reversal. Breaking a non-structural support level is taught as a definitive signal to sell. Yet these specific breakouts frequently trap market participants in several reversals. The high failure rate of this setup stems from a reliance on a single incomplete variable, that is the price. Understanding market direction requires looking at the relationship between momentary price movement and the underlying structural value. Price serves as a measure of momentary exploration. It represents where the market is attempting to go at any given second. This chart shows a theoretical volume profile. The longest node highlighted here is the point of control, or the POC. This represents value. In a strong move, price drops and the point of control physically migrates down with it, confirming institutional acceptance of lower levels. In this second case, price drops sharply again, but the point of control remains anchored at its original position. The market is exploring lower levels, but volume is not transacting there. This divergence between price movement and volume acceptance is the structural precursor to a market reversal. This intraday chart tracks a multi-phase auction. Following an initial gap up, the market establishes a point of control in the upper quadrant as buyers build value at higher prices. During the second phase, the market initiates a sharp downward breakdown from those morning highs. The volume profile data shows the heaviest transaction volume following the price, and the point of control migrates downwards to match the new lower price floor. Because volume followed the price, this is a valid bearish auction. Lower prices are being actively accepted by the market. The downward momentum eventually stalls. The price action flatlines, forming a temporary base before reversing and climbing back into the morning's price zone. As price re-enters that upper zone, the bulk transaction volume shifts back to the highs, and the point of control returns to its original position. While the market accepted lower prices temporarily, it failed to continue that trend. Acceptance without continuation results in a structural failure of the bearish auction. Now we reach the critical phase. Price drops again and breaches the established low of the day. In traditional technical analysis, this specific breakout is interpreted as a high probability short entry. However, the volume profile shows that the point of control remains stationary at the top of the chart. It is ignoring the price breakdown. The market is quoting lower prices, but the actual transaction volume is refusing to execute at these levels. Large-scale market participants are not committing to this lower pricing tier, leaving the price movements unsupported by actual volume. This measurable divergence identifies a trap for retail sellers who are reacting solely to price action. Structural tension dramatically increases when momentary price pushes far away from established value without any real institutional backing or volume commitment. When that tension breaks, the market rejects the breakdown level and price snaps directly back up to the stationary point of control. Because the lower levels were rejected by market volume, price reverted to established mean where transactions were actually occurring. The reversal followed by the structural data provided by the point of control's refusal to migrate during the initial breakdown. This leads to a primary rule for trade execution. Avoid aggressive directional trades on a breakout if the point of control data does not confirm the move. Capitalizing on a failed breakdown requires waiting for the price to cross back above the breached support level. Once the entry is triggered, the target is set at the stationary point of control, the level where the market has already proven volume acceptance. Risk is managed by placing a stop loss below the absolute low reached during the failed breakdown. This framework allows a trader to stop predicting breakouts and start reacting to their structural failures. Market traps are not the result of random luck. These traps are populated by participants who trust momentary price exploration without verifying volume acceptance. The data provides a binary map. The price movement paired with POC migration indicates trend continuation. Price movement without POC migration indicates a structural reversal. Strong moves shift value. Weak moves only shift price. Asymmetric opportunities in market structure develop when a trader identifies a structural failure and reacts to the resulting price reversal. Before going any further, please subscribe to Mind Monastery and don't forget to like, share and comment below this video. Now we'll go to today's market breakdown. So in the first phase, we saw that the market opened gap up and it started to build value in a higher region. This means that buyers attempted higher price acceptance. In the second phase, the prices migrated lower and started to build acceptance at the lower area. POC also migrated down. This means that it's a valid bearish auction. At this point, the market clearly accepted lower prices. Phase 3, we saw failure. The market re-entered the earlier value and started to stay there. This points towards a failed bearish auction. The market accepted lower but failed to continue lower. In the fourth phase, the POC migrated upwards. It shows a re-acceptance of the earlier value. Value rebuilds at the earlier zone. In the next phase, prices tried to move above the value area but failed. This failed auction caused panic downside price movement. And in the sixth phase, we saw that this panic led to breakdown of the day low. Now the trap shows up. Price breaks the day low. This looks very bearish, but the POC does not move down. The price broke the level, but the value refused to follow. This tells that it was a weak move and there was no commitment and it's a trap for sellers. In the last phase, the pullback from the lower prices can be seen. The prices reversed back. This confirms that the breakdown was not accepted. Now let's quickly look into tomorrow's key levels. The primary decision zone will be 22,950 to 23,000. The important resistance is between 23,000 and 2350. Acceptance above this level means a bullish continuation. The support is at 22,750 to 22,800 zone. This is the current reaction zone also. So a breakdown below the level of 22,750 can lead to further downward movement. Please remember that all this is only valid if the POC shifts along with the price and the volume profile confirms acceptance. Now what to watch in the next session? As said earlier, the bullish scenario will build up if there is an acceptance above 23,000 and the POC shifts higher. A bearish scenario will build up when there is an acceptance below 22,750 and the POC shifts lower. But most likely, there can be further rotation. So, we are coming to the end of this video. And as you know that today's market was not about direction, it was about disagreement between price and value. I hope that this video added some value to your trading journey. Wish you a consistent and disciplined strategic trading. Thank you.